Thanks so much for coming, everybody. We've been doing this for a number of years, and every year it gets more and more fun of seeing people show up, talking with each other, some new relationships, and this really wouldn't be possible without great clients coming and showing up. Also want to thank our team. For some reason, they're all hiding over there eating right now. But wouldn't be possible for me to come up here and do this presentation if it wasn't for our team helping make this happen. And always special thanks to Cassie and Bat. Cassie's the one who makes all this stuff happen so seamlessly. So thanks for coming. I'm always excited to do these things, but I'm authentically positive and excited about where we are in the market right now. So I think sometimes people leave some of these things going, oh shit, is it really that bad? There's so many signs of positivity out there. We'll talk about some of them today. We'll dive into some of the dynamics. But overall, I really think we're in a different era of the market. So just kicking things off, our agenda today is similar to those of you who have been here before. Talk about rent and vacancy, talk a little bit about the development pipeline, talk about what's going on in the sales market, and today we're going to finish up doing a roundtable discussion with me and my partner Jerrid, talking about dynamics in the market and some active transactions we're working on right now. I like to headline these, and then for those of you who aren't used to this, all the data we put up is free. It's on our website. There's a link to the research. So reach out to anyone on our team if you want any of the research reports behind all this data. Happy to provide them. People do ask us, is it okay to distribute this? Yes, please distribute it. Lenders, everyone. For some reason, the appraisal department, City of Seattle, only got the reports where values were increasing, and then the appraisal department didn't get the reports where values were going down. I don't know about that snafu they had there, but we're working on that one. So moving on, big picture, I divided up my big picture this year to what's happening in the operational market and what's happening in the capital market. So in the operational market, it really is just spinning plates, juggling, trying to balance income with expenses, or in some cases lack of income growth with expenses. And it's really been challenging. Those of you that are direct owners here, which is most of you today, I know there's some developers here who've been playing a lot of golf. You should be developing soon enough. But it's been really challenging just seeing actual nominal rent growth and balance that with expenses. So we'll dig into that today, but an acknowledgement of how challenging the market is right now with just barely having a balance of supply and demand, and how that's really translating into nominal rent growth with increasing vacancy right now. In the capital markets, it's a different story today than it was a couple of months ago, and this is really what it's looked like in the investment sales market, is this race to the bottom. And what I've been encouraged about, this was happening, call it end of Q1, beginning of Q2, was if we're not at the bottom, we're close enough. And that was really the sentiment a couple of months ago. And I really squarely feel we've moved on in this behavioral cycle of investing. And this is the curve many of you have seen or studied before, and you go from exuberance to put a gun to my head. We've been in the latter quadrant of that. And people have been talking about buy the smile. Here we are in the smile, and we're in the lower quadrant. The question's always been, where have we been? And I think most of the market entered 2024 really certain that 2024 is the market where we're going to hit the bottom, and when are we going to come off? Is it 24? Is it 25? To the lenders out there, it was 26 or never. But this is where I think we are now, is in this point of hope. And I know that doesn't sound the most positive, but I think there's a lot of hopefulness out there, and we're coming out of this smile growing to the next market cycle. So headline is, things are getting better in the investment sales market. We'll dive into those dynamics in a moment. But overall, the market's vastly different today than it was 90 days ago when it comes to capital markets. Diving into rent and vacancy and what we're seeing across the market, regionally, if you look at where rents are 12 months ago, 90 days ago, they've been pretty flat. I'd say across the region for most owners, you're seeing nominal rent growth in the last 12 months. Certain pockets are seeing some declines, certain pockets are seeing some advancements. This data is from the end of Q2, so it's a little bit dated. We're starting to see some markets pick up, like the west side of Bellevue is picking up, and we're seeing some markets still struggle with a lot of new supply coming in. The difference now between a year ago and even 6 months ago is vacancy rates. And this is what we predicted is we are seeing vacancy march up because there's too many seats for not enough butts right now to be able to allotted. Is we're delivering a lot of units and we don't have perfect demand to match those units. It's amazing we're going to end this year delivering about 10,000 units, which is a peak in this market, but we just haven't had the job growth to keep up with it, but we haven't had the rental rate decline. So I think that's the positive news. If we look down county by county, what's different in this graph than what we've seen before is we march through each one of these counties. In each one, we're seeing across the board green when it comes to rent growth. So across all 4 Western Washington counties, we've seen at least stable rental rates or maybe small nominal increases. It's the vacancy that's picked up. And that's really what happens when the market's in equilibrium, or what I might call right now a little bit of disequilibrium, is the fact is we're maintaining rental rates, but we're losing a little bit of occupancy. What this doesn't show, and we'll talk a little bit, is what's happening with delinquency, and that's the other side of the coin more in suburban markets, especially with older product. But I'd say the last 24 to 30 months, I've never had green across the board in all 4 counties. And what that tells me is everyone's caught up with each other. And now it's just a matter of what's going to pick up first. We'll talk a bit about it in a moment, but what I noticed last cycle is, and which is pretty typical in this region, is Seattle led coming out, Bellevue was next, and it spread south and north. I think it's going to be very opposite this cycle, is I think the east side's picking up first. It's going to lead the market in Bellevue across the east side, followed by Seattle, then north and south. That remains to be seen. But it's going to be an interesting dynamic as we're coming out, which market's going to lead. So turning to the urban markets, taking a look, this is Seattle. We call our 12 or 14 urban neighborhoods. Those of you that have attended before have seen this slide. It's pretty similar. Big run up, something called COVID happened, rents went down, we picked up, and then we really just flattened. And Seattle's really struggled to come out of post-COVID rents. Those of you that track the Bay Area, the exact same thing has happened in San Francisco. Rents in San Francisco did not move for 4 years. The flip side is in San Francisco, it's really hard to deliver units. And I've got some clients that own in downtown San Francisco that are seeing near double-digit rent growth in San Francisco right now, which is really fascinating. We would have near that, but for the number of deliveries. And so we'll talk about that in just a moment. So it's interesting to see we've been flat here, but other cohort markets, and I'm talking about Portland, the west side of LA, San Francisco, very similar dynamics. People moved out to the suburbs. We can look at some case studies in other cities to figure out when we're going to grow out of this. Vacancy side, it's been much different. We had a little bit of vacancy tick up until we caught up with new deliveries of office buildings in 2019. COVID was horrible for occupancy, especially in these urban markets, especially close in. And then we caught back up. And really what happened is rents dropped. We saw rents start to stabilize, occupancy stabilize, and now we're just ticking up a little bit. The reason we're ticking up now is in 2021 and 2022, the capital markets were very accommodative to new development. And a lot of cranes got erected, and that we're delivering those units right now, and that's why we're seeing this vacancy tick up when it was otherwise pretty well controlled the last year or so. So I updated the slide to throw in vacancy just so you can see, or throw in development, just so you can see the impact of new development. You can see each of these cranes represents about 1,000 units of development. We were able to maintain really good rent growth as well as controlled vacancy amidst a lot of new units coming to market. And you can see how anemic it was in 2022, but then developers started delivering these buildings that got capitalized in early 21 when rents grew and treasuries dropped. This is where we are now. We're all keeping eyes on when are we going to stop the deliveries. I think the consensus is we're just about there. The reality is there's still quite a few units that need to be delivered. We don't see the cranes right now because the buildings are closed in, watertight, and they're getting finished right now. We're still going to see quite a few deliveries through 2025 and into 2026. They're in certain markets and not others, but we're not out of the woods. But what we're seeing, and we'll talk about this when I talk about sales, we're seeing buyers starting to underwrite through this into rent growth on the other side of it. What we're not talking about is the number of permits. So there's a huge quantum of buildings on the other side of this. And to the developers in the room, it's no surprise. The question is, under what energy code, how will they get capitalized, where are they located. It remains to be seen which of those we're going to develop. But we're starting to get out of the woods in the urban markets, but for the new deliveries, and that's what we're really tracking closely. Now, turning to East King, very similar story as far as new development, and where we ran up, we saw really good rent growth for a number of years on the east side. Developers caught up, so it sort of went down a little bit as a lot of new supply came, and then COVID really helped the east side. We saw massive rent growth on the east side coming through COVID. What's interesting is it's now nominal or dropped on the east side, and the reason isn't for demand, it's just delivery of new apartments. So the curve on the east side, this is the vacancy. Even though the rent growth has subsided, you can see it dipped. We had a lot of demand early cycle, not a lot of developers delivered. Developers started to deliver, so we started to see market vacancy tick up, and then COVID happened. And we had this amazing dislocation in so much as rents grew really quickly, vacancies under control. If we look at development, a decent amount of development on the east side, nothing compared to Seattle that got the lion's share of development. There's still a lot to be delivered on the east side, but units permitted, it's pretty slow of actual permits. I have some slides, this is all available, it's not going to be memorized, but there's still about 16,000 units in planning on the east side. So there's a huge amount of units in planning on the east side, but actually under construction and that are permitted today, it has slowed down remarkably. And that's why I really predict we're going to see rents really jump on the east side, but not to the deficit of Seattle. And this is one of the favorite slides I've had that I put together in the last couple of months, is just comparing rental rates pre-COVID. So that's what we have. Seattle was just below 2,000, Bellevue was 2,150, or I should say the east side. Rolling forward to midpoint this year, rents in Seattle went up nominally. Rents on the east side went up over $500. So if you look at growth in nearly 5 years on Seattle, it's about 1% year over year, which is nearly nothing because incomes haven't really dropped. It's just the fact that desirability went down. It wasn't the ability to pay, it's the willingness to pay. Whereas on the east side, rents have gone up 4x. Now you can say that, what Mike Scott used to say, the skew of the new, but there's been a lot of new in Seattle as well. Average unit size on the east side are bigger than Seattle. They've ticked down a little bit. They're not quite at parity. But to me, this is really telling. There's two things this really tells me. One is the east side's very desirable, and people can pay big tickets for rents. The other thing it tells me is there's a huge ability to pay higher rents in Seattle. There's not yet a willingness. So people are looking at, we need job growth, we need hiring. No, we don't. We just need clean goddamn streets and police officers here. So people want to come back to Seattle, because it's not that far to come across the lake and live in Seattle, but it's worlds away if you're having to deal with all the stuff that we've had to deal with the last couple of years. So this isn't to say that Seattle's going to take off to the deficit of Bellevue. I think both boats are going to rise, but it's really interesting if I go back and look at what's happening in San Francisco, they're probably 12 months ahead of us. I think that double-digit rent growth that they're experiencing is going to happen in urban Seattle, because downtown San Francisco is far more blighted than we are right now. It's cleaned up, but the bodies aren't back. I was just there a couple of weeks ago. The bodies are back downtown here in Seattle. So don't want to belabor this, but I think it's a really interesting dynamic that will translate to markets north and south of us. North King was pretty flat. Rents went up in Seattle early cycle. We've seen this slide before. A lot of new deliveries. Ticked up from COVID. They've kind of balanced out on the north end. We've seen a decent amount of up and down with vacancy. This is really hunting of owners trying to figure out what's the right rental rate on the north end and how do we deal with new deliveries. But what's happened right now is vacancy is shooting up because we're seeing a lot of deliveries north, and we also saw them push rents. And so you can see that right now. This is what we're contending with. A lot of that's new supply. Clicking forward, you can see that's a lot of units for the north end. So there's not many number of units right now. So I love the north end. I think it's very comparable to what we're going to see, what we saw in the East Bay of San Francisco the last 20 years. I think there'll be a lot of growth going north of Seattle because east is so expensive, but we are going to have to get through a spate of new supply. After that, not too much more. So I think we're going to see rents taper, maybe not taper, but not grow super fast north for a bit of time. And then I believe they're going to really take off. Because from a dollar amount, they're really not that much lower than Snohomish, but they're much lower than they are in Bellevue and Seattle. Looking at South King is one of those markets that's had sustained rent growth almost without question. You can see what's happened, but for the first time in the last 10, 12 years, we've seen it be pretty flat on the south end. And a lot of that is in 2022, transfer payments, so government subsidies shut down. They weren't getting subsidized rents from COVID. We haven't seen a lot of job growth in the core, so that hasn't pushed blue collar job growth. So it's kind of flattened out. And you look at vacancy was pretty good, especially post-COVID, really dropped down. Now it's picking back up. I didn't have good enough data to put up here to trust. The other thing that's ticking up is delinquencies. And that's really, so if you look at economic loss versus just vacancy, economic occupancy in the south end is pretty tough right now. And we're seeing a lot of owners just want to get out of that market because of that. That's what this doesn't show. I think South King is the most heavily traded market we have. It's been a fantastic market. What it needs is growth in Seattle and Bellevue, and then rents will pick back up, because we don't have much development down there. So that's what really that market's waiting on. You look at Pierce County, it's been steady. You look at the total ticket price of rents from last cycle, they were pretty low. So there was a lot of room to grow. It's flattened out. This does include downtown Tacoma, which really helped School of the New, a lot of new product. But you can see here with occupancy, this is what was happening. Oh wow, opportunity zone, let's build a bunch, and it shot up. So when you look at the crane count, very few cranes in Pierce County, but if you look at Tacoma is just not prepared to absorb thousands of units every year. It's just not prepared to do that. But between people wanting to go more suburban, get out of Seattle, QOZ deals, we saw a lot of new development in Tacoma. Very similar thing in Bremerton. So it's struggling right now. It will come out of it. I think the lack of affordability across the region will eventually benefit Tacoma. Just right now with Measure 1 down there, which puts a lot of restrictions on, I don't want to say removing tenants, but treating people properly when they don't uphold their contractual obligations. We'll leave it at that. That's just not happening in Tacoma right now. I believe it'll get remedied like what's happening in Seattle, but it is a little bit of tough road. Suburban, Pierce is doing really well. Not a lot of new development after that. Looking just more macro when it comes to rents, we're looking at, here's what happened last cycle, real strong growth, COVID hit, rents across the region dipped. This is Quad County region, the data here. From there, they marched back up post-COVID. Treasury rate hikes just disrupted the rental rate growth equation for a number of reasons, and now we're picking back up. This CoStar data that we use, and they're a great provider, and every year their data gets better and better. All the data providers struggle with having really good data. The challenge going this far out is they just go to 50 and 100-year economic cycles, and they just go 3.5% to infinitum. I think we're going to see a much steeper rental rate growth curve come up for a variety of reasons, but I think the takeaway is everyone's predicting rent growth from here on out. It's going to be different depending on deliveries of new apartments, but we're seeing really good trends in the data providers, which means more liquidity in the capital markets. Whether it's debt or whether it's equity, that's what's really been holding out investment, is just liquidity right now. And it's not the availability of capital, it's the availability of capital priced to market returns. That's been the challenge. So big picture, looking at what we're seeing, rent, I'm finally saying growth is on the horizon. I've been saying that in certain markets, but across the board, we're seeing positive signs. I do believe we're going to be looking at really good rent growth by the middle to end of 2025. In 2026 and 7, I really think we're going to have stellar, like high single-digit, potentially double-digit rent growth with just the amount of pent-up demand. Vacancy, new supply is really the arbiter of where vacancy resides. Some owners are doing just fine, they're at 5%. Other owners are really struggling. Either it's because they've pushed rents, there's lack of renters, there's new supply, or they're just challenged getting tenants out. And they'd rather wait and find the right tenant than get another unqualified tenant. So it's almost forced vacancy until there's more demand in the marketplace. And that is happening in the south end. East side is king. I think east side is that perfect balance between suburban livability and getting back to work. And we're really seeing that on the east side across the board. And then finally, the impacts of work from home. Those of you that have been here before know that I'm a work from home denier for a variety of reasons. I don't think it's happening. One part of it is my wife during COVID said I could work from home or stay married. It was my election. I chose to go back to the office. I never left. And I'm steadily seeing people come back. Those of you who know my wife are smiling because I know she would have said that, and she did. So I do think people are coming back to work. I'm seeing the traffic patterns pick up, all of those early signs. The one thing we're not seeing is hiring in tech. It's just been flat. Once the hiring in tech starts, they're going to be paying huge amounts for these people to come back to work. They're going to want them in the office. They're not going to be making these massive investments in $500,000 salaries for senior directors in tech to grow out sales teams and build out AI and say do it from the Zoom. They're going to want them back in the office building teams in the office. No data demonstrates that, just a couple 100,000 years of history that people need to collaborate and work together. So that's my diatribe on work from home. Development, zooming out in this market, we've got 340,000 units. A huge amount of deliveries last 10 years, 115,000, so steadily about 3% new inventory year over year. There's 150,000 units in planning right now. At some point of planning is under construction, in permitting or permitted. And there's 90,000 units of that are on the other half of that permitting side. Where this breaks down is we've got about 23,000 units, give or take. I'm a little bit higher, CoStar's a little bit lower, split the baby here. There's still a lot of units under construction. If units are under construction, they will deliver. And that's what we're looking at right now. The rest of this data is kind of noise right now because until developers can fire back up cranes, we're not going to see new development. But it's really where these tens of thousands of units are is what's going to be the arbiter of who's going to grow rents. A lot of data here, but basically, last cycle about 3% new deliveries a year. You've got a lot coming. What's on the horizon is growing this market by about 50% of the number of units. The reality is we need those units. The other reality is we need more affordable units. So the question in all of this in the mind of investors is, where are incomes going to grow the fastest? And my bet is if you look at California incomes versus our incomes, the ratio of income to rent is going to grow fastest here in Seattle and the Northwest. So despite all of these headwinds of new deliveries, they're needed, and I expect our incomes to grow us out of that and us to see good, steady growth. Looking at a little bit more granular of where these are coming, this is Seattle. So for the past 10 years, we've had about 3,500 deliveries on average every year. And then this is where we're headed to 27, 28, 29. So 24, 25, 26, we still have a couple thousand units to deliver. They're all delivering right now. What we're looking to is getting the other side of that curve. And something's pretty similar in Bellevue or in the east side. They deliver about half as many units year over year, about 1,750, maybe 2,000 a strong year. Same thing. And stuff in 2029 hasn't broken ground. This is a little bit speculative, but this is truly, historically, this is what was delivered and absorbed. And from this point forward, this is what's under construction. So it truly is waning right now, and that's what we're really waiting for to see rents pop up. That and hiring, that's just the flip side of the coin. This is interesting. This is cost versus value. These are my kind of thumb to the air. But if you look at low, and the developers in the room may disagree, but to deliver a new podium style construction unit, so this is core, call it 5/2, 5 to 7, 8-story product, it's about, on the low side, 450,000 a unit to deliver a unit. This is all in land, hard, soft costs to deliver a unit right now. Low side, it depends on where you are, a bunch of factors. And low side, on the sales side, we've seen trades in the high 200s, but in the last 12 months, the average has been about 325,000 a unit, which is massively low, but that's been the dip. Moderately, about 500,000 deliver a comparable unit. 375 has been about the benchmark that you can buy new podium construction in Seattle. And the high side is 550 a unit. This is probably air-conditioned unit, probably over 700 square feet, probably where your land base is 100,000 a door. But comparably, if you were to sell that unit today, you're probably getting 425, maybe 475 on the east side. So we're still playing with that replacement cost story. We'll get to yields in a moment, but this has been the challenge of developer. If you're wondering why there's not cranes in the air, this is what you're looking at of what you could sell that unit for if it was brought to market today. I will tell you that those of you looking to pay $300 a door aren't going to right now. I'll tell you about my rubric in a moment of 400,000 is the new 300,000, but that's just the market we're in right now. Looking at concentration of deliveries, There's a couple of markets you can hear, look at Belltown, downtown, huge quantum of deliveries that are both crane swinging and delivering. And all this data is in our research, you can look at it. This is just the level of sort of granularity you have to look at these markets. I think it's very tough to look at Seattle and say, there will be rent growth or there won't be rent growth. It really depends on who your neighbors are, what's happening in your submarket. Turning to North King, I had mentioned this earlier, this is where I think North King, I love the markets up there. There's some really strong markets. You can see submarkets are now forming. We never really had a lot of growth. We talked about Greenwood, Northgate, Shoreline, Lake City. These are becoming very defined neighborhoods, and there's a lot of new supply coming, which is terrific. Light rail's driving some of this, some of the urban blight is driving some of this. So near term, we could nearly double the inventory in these markets if we build all of these units, so it's something to keep an eye on. The flip side of that is people are moving to these areas because there's attractiveness in these areas, whether it's affordability or getting be a little bit more suburban. Switching to the east side is definitely getting more nodes of where people want to live. There's a lot, what is this? I use readers now, 126% of inventory. So there's quite a bit coming. What's interesting is we used to talk about West Bellevue and everything else. Now we're talking about Spring District, Overlake, Bell Red Corridor. So there's some really interesting, it used to be west side of 405 and Redmond. Now we're starting to really define these submarkets. There's a lot of new development coming in. Capital really likes the east side. And I really think we're seeing, I talked to an owner the other day, they've got a building in downtown Bellevue. It's a little bit older product. I think they've been keeping up with rents. This year they've seen 10% year-over-year rent growth. And it doesn't surprise me. Amazon's taking millions of square feet in Bellevue. We're really seeing rents rise locally in Bellevue. Redmond, not necessarily the case. They've got a lot of deliveries. Certain products doing a little bit better right now. They're having some absorption challenges, which will go away, which always does in Redmond. So just kind of interesting looking at these dynamics. I just point this out. As far as CDUs, micros, very little coming in there under construction. So there is an opportunity. The challenge is parking. It's a zoning requirement. But it is interesting. There's really big rent checks on the east side where there's some opportunities to find stronger rent growth. Some key takeaways. Rough order of magnitude, 1 in 10 permitted sites are breaking ground right now. That number is picking up. We probably started the year was like maybe 3 in 10, 2 in 10, so it's been declining of new starts. It started to pick up. Developers I'm talking to are planning starts next year, whether it's Q1, Q2, they're actually talking about them, versus 3 months ago plans were taken. Weren't even really setting dates. Looking at concentration challenges, we talked about that with the slides, where delivery is happening. Construction costs. Was fortunate enough to hear the president of a big general contractor speak the other day at a ULI forum, and he had an interesting outlook. And his thought was, we've seen somewhere between 10 to 15% reduction in costs from peak to trough. His thought is before those costs drop more, we're going to see developers start signing GMP, signing contracts to start again. His belief is because labor costs aren't going down and material costs have gone down a little bit, he believes we are in the biggest dip we're going to see in construction costs. Like me, he's here to sell things like construction services, so he's trying to get people to sign contracts. But it is interesting to think we need 3 things to happen for development to pick up, or at least 2 of the 3. Rent growth, cost of capital to come in line, and declining construction costs. I have least faith in construction costs coming down. And it's an alignment with what this particular GC thinks and is seeing with people starting to fire up plans again. And finally, new projects. Interestingly enough, developers are tying up contracts, or tying up sites now. I would say 6 months ago, 9 months ago, development acquisitions teams were talking about tying up sites, or they were tying up a couple. Truly, developers are in earnest. Not many are going non-refundable yet, but I am seeing nascent stages of the development pipeline picking back up. And I haven't been able to say this since probably Q2 2022. So we're talking 9 quarters. It's been a long time. So they're going to pick up. We'll see it next year. Our new development study based on all this data just came out. It's on our website. Moving along to sales trends. The sales market has been massively impacted by the adjustment in capital markets the last 2 years. No surprise to any of you who have been in this room before, looked at our data, or have Heartbeat. Like, this was the big run up to 2019, slowed down after COVID, dropped precipitously. I'm behind the slide. Picked up right after 2019, dropped, COVID hit. It's been a rocky road. Where we are today, this is half year data. So first half of 2024, we had 1 billion in sales. The peak was 8 billion. So that just shows you how off we are in sales volume this year. I do expect this to pick up a little bit, but there's just not enough momentum to pick up to save us. I think we'll see a lot of Q1 closings, we'll see some Q4, but it's staggering to see a market that normally trades 300 to 500 apartment units a year, buildings a year. The first half of the year didn't trade 100. So it's been slow. It's as slow as it was in the GFC. Pricing is down quite a bit. Pricing had a big run up. You can see the run up here. It dipped a little bit. It picked back up. When capital markets corrected, went a little crazy in 21, 22, crazy in a good way for our industry. And now it's corrected the other direction. What everyone has been looking at more so than price per unit, price per square foot, is cap rates. And so historically in this market, we were a decade and a half ago in the 6 cap range, we went down to 5 caps, and we steadily marched all the way down to 4 cap deals. And in 21, second half of 21, first quarter of 2022, we were doing 3 cap deals, 3.2, 3.75. It was a crazy market, it was a really strong market, and now they've picked back up. And so really what people are looking at is the cost of capital versus returns, and that has been the arbiter of how someone invests right now. So I put together some tables. This will be relevant for about 15 minutes until the next sale happens because the market's moving. This is where I see spot cap rates are right now. And this has been, I could have put a slide up before. I was on the phone with someone a couple months ago, and we were talking about cap rates this time last year, where the 10-year had run up in late October and kind of stayed there and debt touched 7. We called it universal cap rates. You just needed a 6 cap, you get a deal done. I don't care if it was a brand new core, high rise, or something in the suburbs. We're now starting to gap out. So this is where I see the gaps today. New construction, urban deal in Seattle, 4.75 to a 5 cap. East side, 4.5 to a 4.75. Some trades that are getting under contract right now will prove me wrong because they'll be sub 4.5 on the east side. True story. They're happening right now. There's been a massive change in demand for a variety of reasons we can talk about with the roundtable with Jerrid and I. Looking at suburban stabilized deals, the east side, this is outside of core, 4.5 to 5. They're still low. North end, 5.25 to 5.5, kind of where debt's pricing, maybe a little bit above debt. The south end, I dare say some of these are coming into a 6, but these are stabilized deals. Looking at value add investments, so core 5 to 5.25. This is going in stabilized. So you're getting 50, 75 bips if you're newer. The big trend that I've never seen in my career before is investors cutting off their cutoff date in the 90s. The last several decades, investors are saying, I'll take 80s and newer. And really ever since, for a variety of reasons we don't have time to get into, but ever since COVID happened and people are starting to look at functional obsolescence, they're looking at who their tenant base is, it really penalized. I think this is where the good deals are right now, is we're seeing older product gap out to a 6.5 and a 7 cap. And in some of these, you're placing debt, with a buy down, maybe even sub 5, but near 5. There's a lot of yield, but a lot of the investors that were buying this older product have been trained the last 24 months that they can buy core urban or they can buy core plus at a 5.5 cap, 6 cap maybe in some cases. Why chase older product? Well, they're getting pushed out of the core now because those deals are pricing in the low 4s. So we're in a moment in time where there's some dislocation in the investor sentiment and what's happening in the marketplace. So I think it's just really interesting we're at this moment in time. I do think I'll be here in the spring talking to everyone, and we'll be looking at much different numbers. We'll see these gap out even further. Key takeaways, volume still down, call it 50 to 75% from normal. We're off the bottom. I think that's resoundingly clear. We're coming out of the smile. Good news. The question is, how do you seize it? And I think that's really the question right now, is I think the buying opportunities are waning at the bottom, but there's still going to be some good opportunities running up. It just depends on where you focus. I've talked to a lot of groups that are raising core capital right now. They want to buy core 5.5 cap deals at $350,000 a door. They are too late. That ship has sailed. I think the good play is doing the exact opposite, but we're going to move into more core plus. But a lot of capital is being raised with a different investment thesis right now. Investors are back. There's a return. There's optimism in the market, which is fantastic. Makes all these events feel much better. And then finally, pricing escalating with every sale. You know, I said earlier, 400,000 is the new 300,000. I think with every sale in the core, we're going to march our way up to 500,000 a unit for core podium new construction, which will then enable developers to break ground. And I very much believe we're going to see that as early as next year. In the suburbs, there's a greater disparity in price per unit, but what we're going to see is those investors that were in the core that were looking at 5 yield deals at $350 a door are now looking at 4.5 yield deals at $400, $450 a door. They're going to have to go out to the suburbs chasing yield. And it all starts over again. So call this 2012 or 13. So I didn't realize this, it goes in cycles, who knew? Here we are 10 years later, a cycle anew. So history doesn't repeat itself, but it rhymes. So if you're looking for themes, I think the themes are looking at other urban markets on the West Coast, comparing us to them, and also looking at where we were historically 10 years ago or even 20. So with that, I'll invite my partner Jerrid up here and we'll begin our roundtable. Sure.
You can't read it, make forecasts great again. So the first people to ask questions will get a free.
Yeah, we're giving out hats. Control the deck there.
Testing. Glad to be giving this presentation in October, 2 months ago. Wasn't a lot to talk about. I think the first time we did this roundtable was October of 2022, and at that time I think we had 43 closed sales. This year we're at half of that. So a little less data looking backwards, but I believe on the slide it'll say 22 pending or listed properties right now in Q4. So massive turnaround. We'll probably see more closings this quarter than the rest of the year combined. So jumping in, we'll start with some absorption. So these slides are more about what's happening day to day in market sales than looking historical data. So the important one here, when we look at months to sell, they typically say if it's under 3 months, it's a strong seller's market. If it's more than 6 months, it's a buyer's market, and something in between is balanced. I would say if you look at this slide, for me it's probably over the 4-month mark is when it becomes a buyer's market, because it's felt like that for some time. Given that we've seen a major transition, Dylan, what market would you say we're in right now?
I mean, back to what I was talking about, like price per unit and where capital is going. I think we've, universal cap rates, call it, somewhere around a high 5 to a 6 at the end of last year was very much a buyer's market. I think where we've gapped out is in the core. So if you're well located and you've got new construction, it's switched to a seller's market. I mean, we'll talk a little bit about bids on deals that we're working on right now, that we're routinely getting 10, 20 offers on core deals, and it's very much a seller's market. If you look at the flip side of that and you're not well located, and worse, you're not well located and you've got more vintage product, it's definitely a buyer's market. There's buyers currently putting deals under contract, high 5s, 6s, and these are value add deals that may stabilize at a 7+ yield. There's just not enough bidders out there looking for that type of product. So it really is the tale of two markets right now. And I'd say in the middle is if you've got new construction and you're suburban, just people want to buy new product, but definitely the seller's market in core.
And you and I have been talking with clients, next to each other for years. I think the last 2 years we've been saying, buy core, buy core, buy core. We still saying that?
It's always, it depends. I love the east side. I think the east side is a great market. I think it's still priced to perfection, and it's a bit of a treasury bill. And I think if that's your investment thesis, buy whatever you can in the core and get a seat at the table on the east side. I think Seattle's still undervalued. I think we're gonna see massive rent growth in the core of Seattle. Pick your neighborhood, pick your product type, but I'm still a believer in core Seattle buys and core Seattle development. I think there's a long run there. And I'm a buyer of older product in certain markets because I just think it's mispriced.
One more question on this slide. If we look at 2017, I believe it was Q3, and 2021, these are the lowest number of months to absorb a sale. What was happening in those markets, and do you think we'll be back there again soon?
I mean, it just depends. I mean, I remember you and I were sitting in our office. There's no one from management at Kidder here. I already told you my wife needed me in the office or didn't want me at home. We were like, I think we were back in the office in June, post-COVID, and Jerrid and I were like, how are we gonna sell anything? Like, there are no buyers out there. But I'll put the question to you, like, we were putting deals together in, call it July, August, in the core of 2020. I mean, how does that compare to what the last 24 months have been?
I mean, at that time, there was just so much uncertainty, and we hadn't seen any price adjustments downward in my entire career since 2013. And so the first few deals I put together in Capitol Hill, actually, where owners trying to get out of what was the chop chaz zone, they felt like really great basis buys, and then we saw the pricing continue to decline. I agree with you that we've definitely bottomed out and have been accelerating probably for about 3 months. I've really felt it. And so I think we'll continue to see pricing escalate quarter over quarter. For how long, I'm not sure, but I don't know until we're at a point where the average sale time gets below 3 months. I would guess when that development pipeline slide you had drops off come sometime in 26.
And it's been interesting because we've seen a thesis change. I think on the private client side, to call it under $20 million properties, and you can sort of pick if you want to slot institutional investors. It's very much been, maybe we sell off market, maybe we go to market. You're the broker, you tell us how do we maximize price. It's been interesting. In 2023 was one of the first times in my career where I had an institutional client say, let's go off market. I mean, just was not something I experienced before. And that's because deals were languishing on the market. They were getting shopped more and they were coming out. So I think the days on market was really telling because owners put deals on market, they just saw them sit there. What we're seeing right now is that sentiment's gone. Same client today is completely like, let's go to market, let's keep pushing through. I think what we've really was determined it as the bid sheets, and we're able to make markets, but I'd say it's still really variable with the product type. We've got properties we're selling right now, especially stuff in Seattle neighborhoods, where it's like, let's rifle shot, pick the right buyer, and not let this sit on the market for 3 months because of either location, low yield, whatever the story is. So we're not fully out of the woods. I think it's still asset dependent, but I think it's gonna take another 2 or 3 quarters till we're squarely in a seller's market.
Oh, got some animation here. So next, looking at the listing to pending and closed. I think the market, if I remember right, in 2022 was about half, and that was because at the beginning of 2022 we were seeing the highest pricing we'd ever seen, and I remember my first deal, it was in Ballard, by April of 2022, it was the first deal I brought out in several months where I was uncertain whether we'd get any bids, uncertain whether we'd close. And it's been like that for me since then. However, we've been able to capitalize on getting much closer to 100% of our deals closed. What do you think we're doing differently that allows us to see nearly triple the closings as a percentage of what we bring to market?
Yeah, I like to call this the failed sales slide. It's a depressing one. Like, it just wasn't this market that half the deals that got brought to market. So you look at the first quadrant there, excuse me, in 2022, there was a 50-50 shot that if you took a deal to market, it would sell. I've been in this business for a while. Those are not good odds when you're paid to go sell something. And I think what we did was we adjusted in a couple of areas. One, seller expectations. We really tried to figure out what the seller motivation was. If their motivation was to maximize proceeds, we said probably don't go to market. And I'd say a lot of owners shop brokers, like forum shop until they got the right answer of where they wanted pricing to be. So I think we got much more judicious. We also really figured out where pricing was and just really decided how to price a deal. And pricing strategy, I mean, in call it 2014 to 19, pricing strategy was simple. Price it more than the last sale that closed. Because it's pretty easy. Something sold, price it for more, and the buyer will show up. And I think we just really tried to figure out where the buyers were and get clients on board. What was your sense if we didn't get them on board?
Yeah, I think being judicious was common theme, and being realistic. The thankful thing is that we have quite a bit of volume as a team, so although it might not be similar sized deals, you can relate back to how many tours do we have, how many bids do we have, and take that information and see where the market is. So a lot more data points that were live, as opposed to if you're working on one sale a quarter, it's hard to really peg where pricing should be. So being able to set realistic expectations and then go meet them is probably the number one thing we had success with.
And from an ownership perspective, it's tough. I mean, for those of you sitting in the room looking to sell, you go survey 3 brokers. This happened on a recent listing, and there was a 30% disparity in values between the brokers, which is massive. I mean, I can see 5, even 10. But from high BOV to low BOV was 30% differential. And we were probably 20% off from the high, and we still got hired because the owner said, I think the high is bullshit. Then they said, go out and get it. So it's just kind of what we have to do is what we do. I think it's challenging in the room to figure out like where pricing is. And I think for any of you that are looking to have a sale, potential sale in the next year until there's like clear signs, is really thinking hard about pricing strategy. And I think that's where we're really focused, is how we strategize, how we're going to price for someone who wanted to clear the market.
So this is a graph that's similar. We couldn't quite figure out what the anomaly there in 2021 was, so we highlighted it that we don't know. But these were
bad data.
Us related to the market. So as you can see, sellers, brokers, high expectations. I think rarely are we going to see a market where we're typically beating pricing expectations across the board. But we had several years where within 1% or 2. We've got, as I mentioned, I think 22 pending or listed deals right now. Are you feeling like you're exceeding expectations or exceeding pricing on anything recently?
Again, it's very much in line with the product type. I think what we've gotten very good at is understanding where buyers are, where capital is. And I've been really happy with the core stuff we've had, the newer core stuff. We've pushed the market and exceeded it. I'd say my guidance to owners in the last year and a half, and I see some of them in this room, is like, we're not going to push pricing that last 10%. I think this is where the market is. Maybe we get 2, maybe 5% above it. There's just not enough buyers to push pricing 10%. And now we're like a couple of last deals I've worked on for core deals, call it built in the last 30 years, we pushed pricing from initial bids or bottom to top 15, maybe 20%. And part of that is we priced them more efficiently, so closer to the market's risen up. And contrarily, in markets where there's just less demand, older product, more tertiary markets, we've pushed pricing, but we're still in that 10% bandwidth. There's just not enough capital to show up to push something in a suburban market that's built 30, 40 years ago, that extra 10%. I think that gap's going to close, but that's how we're seeing it.
So pricing strategy, are you recommending, I just had this conversation yesterday with the client, should we go low and get multiple bids to exceed? Do we go at market pricing or do we go high?
I'm going to put it back to you because you have a good theory on this. This isn't first.
Do I?
You do. Well,
You're kidding.
Yeah.
So in the core, where I specialize in private client sales, probably 5 to 25 million. So we are pricing more of our sales. Once we get over around $10 million, they'll be unpriced, so it gives us flexibility with guiding the market. But as far as where the market's been and the expectation of the buyers that we're going to buy things for a discount, we do need to price the deals higher than we expect them to sell at. So that's part of the strategy. No one wants to pay full price right now, for the most part. However, in the last, I'd say 2 months, and that's why I was excited to get up here, I've had several deals where we started to adjust a little bit more close to where market was, because we thought we might get either multiple bids or someone that came in really quickly and went full price, and we've had that happen 3 times. So really getting the pricing accurate to market today is leading to a very committed buyer, because they're starting to see some of the sales comparables come in higher than what they thought they would be, and now they're trying to catch that. So I think pricing perfectly right now in the core where I focus is really important. Obviously, if you're going unpriced, gives you some more flexibility when you're out there. The challenge with going unpriced on smaller properties, they don't have an acquisitions team, so the likelihood they can just spend time underwriting a property they have no idea what it's going to sell for is pretty low, and you lose buyers.
Yeah, I mean, it's been interesting. I remember last cycle, like when COVID hit, John Halverson, who was up here speaking last time on our roundtable, priced a tower. And I was like, holy shit, who prices a tower? No one had ever seen that. And I think it was the right strategy. You had to get people to show up. You had to tell them where the bids were gonna come in, because no one was gonna buy during COVID. We thought no one would buy it. It worked out well. They got a good buyer and they got it sold. But the psychology in the more institutional space, or mid-market institutional, it's conventionally you just don't price an asset. So it's more where pricing guidance comes in the whisper price. And it's just been very dynamic. I think it's interesting, we've actually had clients say, price it lower. We want you to price it lower, we want to make a market. And we've said, well, people want to feel like they're getting a good discount. It's almost like JCPenney's strategy. They've got a really interesting strategy. JCPenney's one of the stores, and the head guy at Apple said, you're not pricing it high enough, and then they literally bankrupt the company. Is they just run discounts all the time, so every shopper knows they're getting a coupon of 25 off 75. That was kind of apartments for a while. No one was gonna pay list price. And so right now it's really taking a lot of pricing strategy, because assets where people want a discount, you gotta price high, but where you feel like you can make a market, you wanna create competition. And so it's still, we're in a new territory in the last 3 months that we just haven't been in before, with this much dynamics of buyer psychology. It's fantastic, because I feel like we can do our job again. I mean, there was a time where it's just like, get it out there and the bids are gonna come in, because we weren't really able to push people. But we're back to working for our money really hard and figuring out how we strategize to make our clients, I like to say at least triple our commission, is how do we get buyers in there and push the market? And it's been a lot of psychology. And I think here, I mean, it demonstrates in 2022, we were priced within 97% of where it traded, and the rest of the market was off quite a bit. So it's just been interesting seeing, because we have peer groups that are taking way different strategies.
I think it's the old version of the deck. I caught that. It's supposed to be 2024.
Oh, there we go.
So shifting a little bit, when I got into this business, I don't think I can get away from a meeting without Dylan talking about how excited he was about dirt. And you can see here in 2016, half of what we sold was development land for construction, and half was existing apartment buildings. And in the last, I guess, 9 months, because this is year-to-date slide, sold 0. You obviously had some slides about development. What do you feel about the development market? If you're representing seller of land or buyer of land, what are you recommending? Are we buying now, or is it still hold?
Yeah, the development, what's happened over the course of the last 2 years, development really stopped mid-2022. It was nearly impossible to capitalize a deal past Q1 2023. And some happened. What we're in a spot right now, we're just shifting over the developer clients I have, and I meet routinely with most every major developer in this market and all the local groups. People were looking for raw. They just wanted raw. They wanted to wait. They didn't want to have to make a critical decision right now. And literally in the last 90 days, we're having groups show up saying we want permanent sites. We want to go, we want to break ground, we want permanent sites. And I think it's less about—
Does anyone here have a permanent site they'd like to sell?
Yeah, leave your card with Cassie.
the developers always want to go, because a lot of the developers is what they do. Many developers don't have existing assets. They develop, that's what they do, that's what they love doing. So they were always looking for new sites, they wanted something to do. It's more a function of what capital's willing to do. Capital just did not like the yields, and so we were hamstrung. What's happening now is certain capital is getting more entrepreneurial. We've also seen spot cap rates drop. And so if cap rates have gone down 50 bips, the development premium should correspondingly reduce, what we call yield on cost, and we should be able to get developments out of the ground soon. So it's been a rocky road, but it's been pure raw. I'll take raw land, I'll make a decision in 2023, 2025, 2026. So it's a shift. I would say maybe 10%, 15% of the capital is there now, whereas before it was nearly zero. Every time I talk to a limited partner and they said, find me a 6 yield, so yield on cost, I find them a 6. Find me a 6.25. I finally ended up, I thought I was in Oregon, I kept driving until I could get like yields. And at one point this did happen in Tumwater, I just got in my car and left. I was like, no offense, is anyone from Tumwater in here? Really beautiful, some great Starbucks down there, but I literally was in Tumwater like looking for 6.5 yield dirt. Like, this is not my expertise, and drove home after I filled up my tank a few times. So what the capital's been the arbiter, and I was just meeting with capital in San Francisco, a few groups, and they're now sub 6 yield on cost, which is like the holy grail. So I think we're gonna see it come back. A very long-winded answer. I love development land. I'm happy to see people want entitled sites. We're gonna see cranes swinging. We're gonna see starts next year. It will take a while. The best of the best sponsors, the best sites, they'll get it first.
Shifting to our team's stats as it relates to year-to-date, comparing the same exact time last year and the year before, you can see the number of listings and pendings. Oh, that's not what I wanted. Okay. So the number of listing and pendings has been extremely low for heading into Q4, which is typically a high volume month for us. And this year we have 22 listing or pending. What do you think led to that, and what do you think is going to happen with, and I think we saw some of it, cap rate compression?
Yeah, and if you look at these slides, year over year, we went from 9 in 22 to 9 in 23 to 22 in 24. So it's heading the right direction. I'll say part of this is, I mean, Jerrid, a vast majority of what you do is, a lot of these are deals you're working on, just because the bigger deals are just starting to come back. I think there's a variety of factors. One, we're controlling a lot of the Seattle stuff, just with what the team you run, the business you run. We're getting a lot of signal, people that realize that you're the game in town to go with, so we're getting that. Kudos to building that business. The other is people are seeing that there's brighter days ahead, and they've held on. People, they wanted to hold on. Like, I need to sell, but I'm not going to take this massive loss, or what feels like a loss. And I think they're feeling like, I'm comfortable that I'm going to get a decent price, and I'm not going to be selling at the absolute bottom. Yeah. What's your sense? You're signing a lot of these listing agreements.
No more, who told me this? No more of the buyers that have the case of the twos. Too big, too small, too old, too little parking, too whatever the hell. They're
Didn't
going to
buy
us.
it.
So now it's like, yeah, you can say too old, that's fine, but too much of everything, you're just not going to be an active buyer. So people are showing up, putting in bids, they're seeing they're missing out on the last opportunity and wanting to really buy into Seattle. I think it's still being priced at a discount. So that's been huge for us. For you, on the institutional side, obviously average deal size for you in 2022 is 42 million, less than half that almost the last 2 years. I know you've got a 40-something million dollar deal under contract right now. What do you think happens next year in the larger sales?
Ryder, raise your hand. I'm so proud of Ryder. He joined us a year ago. I think he knew what an apartment was. He was just out of school. He's our analyst. He's awesome. How many deals did we underwrite at $1 million of NOI? Like 15 deals came in at $1 million of NOI, and some sold for 12 million and some sold for 25 million. But it just was kind of this point where once you got to a larger NOI, you were a big enough owner, you had more staying power, you were more institutional, and you were holding. You just held. A lot of people held these last 24 months. Now I would say our average BOV is probably more in the 30 to 50 million range, moving up to 60 to 70. But, I mean, for a while, it was just sort of the owners that said, we're gonna get out of the market, and if it was under $1 million, Jerrid was working on it, but that was kind of the break point. So we're seeing enough
Under
confidence.
$1 million in NOI.
In NOI, yes, NOI. The sentiment with well-capitalized owners is, it's time to move on with the business plan. I want to sell this and buy something else, I want to go develop, and I think we're off the bottom enough to get sellers back to the table to, some of these people, it's loss aversion. I don't want to take the loss right now. Some of them are saying, look, I like where the market's headed, and I want to recapitalize. I want to sell this and go find another investment. So I think the mentality has changed, and I think there's a lot of just confidence in where we're headed.
So last two slides, a little bit of a speed round. Nothing really changed year over year for seller motivation if we look at this. So the major ones, time of life. We've held this forever. Now is as good a time as any. We want to move on. Most of my clients 60s to 80s. Or our debts due. I mean, nothing else was really stood out other than some debt or time of life.
What are the 3 Ds?
Death, dissolution, or divorce.
The Holy Grail.
Holy grail. So no one's time in the market on the seller side. That's the one that I think will change markedly. How much do you think that changes and when?
Yeah, I think we're gonna see a lot more people trying to just time the market. I mean, they've held for a while, the market's picking up. So I think we're gonna see market timers pick up, and that's gonna triple, I'd say, in the height of 16 to 19, probably 75% of the sellers we were talking to are like, now's the time to sell. Prices are escalating. I don't know if we'll get back there, but I mean, I'd say that's the biggest thing. The debt due, the distress, I think that's gonna stay fairly small.
And I know that was a major concern, and it's talked about quite a bit in the markets, this underwater debt due forcing all these distressed sales. I mean, we worked on, that I can think of off the top of my head, one that was truly distressed, upside down. The rest were, hey, it's not a pretty picture, we want to get out of this thing. Do you think we will have this day of reckoning that all the buyers hoped for, or did all the sellers squeak by and brighter days ahead?
The latter. I mean, there's select ones. I usually say bad location, bad product, bad sponsor, and most people don't want to buy that product. Have you seen much in the core, just true distress?
No, I mean, most of the people that are hiring me are 60 to 80 years old, they're low levered.
Their distress is different.
They're distressed because they're tired of, frankly, tenants and toilets. So it's more Seattle City Council, it's more proposed rent regulations at a state level than anything else. And so one of my favorite clients last year had a building their father developed in 1959, held it for, I guess it was 60-something years. And when I asked him, I said, why now? It's not the best time to be selling. She's like, me and my sister are old, we're kind of poor, but if we sell this, we'll get, it sounds like, according to you, $8 to $10 million. I don't care if I have 10 or 8, that's a lot more than 0. And I'm 83 years old. Go to your thing. I'm like, fair enough. So she bought a horse, a nice horse.
Really nice horse.
Flip into buyer motivations. So obviously, majority of the reason opposite, timing the market, but we've seen a ton of growth in this long-term hold. What do you think has led to that?
Yeah, I think that it's just the flip side, the other side is I think buyers, I think there's 3 main motivations. Is one, you're just not making money. We're a fee-driven business, and they want to get out and do deals and make money. 2, I think they have the capital behind them. The capital wants to get moving with them. And 3, there's brighter days ahead. I think people are seeing the crane counts dropping. They're seeing Seattle is getting cleaned up. So I think just buyers are feeling true tailwinds behind them right now, and they're ready to go.
Yeah. I guess the last point I'll make on the 1031, working on 2 sales right now for the 1031 buyer. You can see it was such a low percentage with such a low volume of sales. So now that we see the volume of sales picking up, we see the 1031s picking up. But we do more urban business, and so I think I'm seeing more people want to get out of that suburb market you mentioned, where their economic loss, once we factor in people not paying, is really starting to eat away at their bottom line and seeing the core of actually a safer market. So that's the last graphical slide. A couple bullet points we'll throw up there. for sellers and buyers. So pricing, according to the market demand is really important. So we talked about that here. Some of the older product, you need to price it right. There's not as much of demand for it, whereas if you have a newer core, it might make sense to get pretty aggressive on your pricing. And then quality's been in high demand for the last 2 years. So if it's a great location and a great building and a newer vintage, we had no problem getting multiple bids and getting the deal sold. If you went outside the core, went to a neighborhood that was a little less known, thinking it was just too expensive to buy in the core, I think that's been a challenging market to own in. And then just keeping up with market rents. This HB 2114 rent control is back up for votes this Q1 2025, and some of the people that helped block it last time at a Senate level are no longer in the Senate. So it is a risky proposition we could talk more about, but definitely keeping up with rents is really important. And then for buyers, we've been saying this for years, you do the homework, make the offer. We never know who's gonna end up buying the property. It could be because of the price, could be because of the terms, could be a lot of factors. So if you like an asset, make your offer. The distress thesis that we talked about, I don't think is coming, and therefore buy great assets, and then just pay attention to the markets that are undersupplied. So specifically during the pandemic, you'll probably remember Capitol Hill, Chop Chaz, West Seattle, lost a bridge, U District, lost a school. Those are the 3 most underdeveloped markets in Seattle now. So it's an interesting time to be early on those markets as we start to see rent growth in them, because they'll be the first ones to see the supply of new apartments turn off. So after that, I'd love to open it up to everyone if you have any questions.
First 4 people who want to see 4 cap deals in the market get a hat, so raise your hand with questions.
What is the rent control bill that they're trying to pass?
So last year, what they proposed was a 7% cap on rents, which people say, right? It's not awful.
Wear it proudly.
If I could raise my rent 7% every year, I'd do it. What they didn't include is any carve out for new construction. So all new construction would be subject to rent control as well, which typically doesn't pencil. So we'd see a major constraint on supply, and therefore no new development would make rents, or at least the demand in the market, get quite a bit higher. So that was the biggest missing piece. There's a few other ones about when you can, how long you have to give rent notices, limiting how much deposits could be, limiting fees. So most of these already exist in Seattle, but that was the big one, like 7% cap statewide. And I can't remember the word. I talked to an attorney about it. He's like, if there's one thing you could advocate for, it's called something. But in his words, it meant that at a state level, they could pass rent control. Those statewide, and no municipalities could add to it. And so that'd be a big win for cities like Seattle that are so much more progressive, and we'll probably try to prove to everyone else how awful they can make rent control. So if I think of that word, I'll let you know.
I know Tim wants a 4 cap deal. I've
And
done the underwriting.
you didn't get it right. So speaking of, how are buyers, winning buyers, looking at exit cap rates now? Flat, downward sloping, what are you seeing amongst the?
Yeah, I would say for the last, many months, terminal was the same as going in, because going in cap rates were high. We're now in like an interesting part of the market where they're actually underwriting terminals below entrance cap rates, depending on where the deal is and what it is. But I'd say, traditional underwriting was kind of 10 bips a year. So like, you're holding for 10 years, you exit 100 basis points higher than you came in. The summer, core might have been 50 bips. But it really is, it's inverted in this period of time where people are now working on a core deal, they're buying at a 5 and their terminals at a 4.75. And so it's just been a big difference. I think that will harmonize over time as cap rates compress and people are going to start to expand their terminals. But there is an inversion on core deals right now.
The biggest adjustment I've seen in buyer underwriting, whether pricing is going up or down, is just how they treat older product, exit cap rates. Because there's a point in time when we were selling a 2005 building for nearly the same cap rate as a 1990 or 1960s building. And now everyone's gotten the notice of non-renewals and seen their insurance double or triple. It's definitely a harder asset class to own and operate. So we're seeing that shake out.
Well,
Seattle's lifted that micro housing deal to be able to develop like 120 square foot units again, or 150 Is that gonna actually start happening again, or are you gonna stick around that 220 side?
Yeah, it's interesting. We put out a micro report every year, and I was editing it this morning, so I got some data fresh in my mind. Right now, we still have a pretty large supply of CDU units, call it 250 to 300 square foot units being developed.
Small efficiency dwelling units to the uninitiated.
You could basically fit a CDU in there, you ride on the clock. So as those continue to deliver to the market, we've seen compression on rents and vacancy stayed pretty high. So I think we need to see those deliver some growth. And yeah, is there a place for 120 square foot units? I think so. I've sold a lot of those buildings. No one's bought a second one. So I'll keep selling. Don't tell anyone that's not here that I said that. But they're tough. We say you're buying a business. You know, it's not this like cash machine. They can be, but you really got to be on it. And the shift in mindset is to leasing. You have to just be on it with leasing. If you have a great leasing agent, I've seen some clients do extremely well with micro apartments. And if they let leasing go, you can be 20% vacant in 2 months.
Last question.
Yeah. I know a lot of in Seattle, people like to buy older product called value add. Now these days, these apartments are facing like insurance challenge, so not too much value add. So did you get a lot of sellers say, hey, I want to, give you a listing of finding a reasonable insurance quote? Yeah, and how do you deal with this? Of course, you don't turn off those potential customers, but how are you going to help them to liquidate their assets?
Yeah, it's important. I think when selecting a team or a broker is really tapping into their vendor network. And so the best thing we can do, and I've learned this from owning some apartment buildings and hiring third-party managers, the best managers have really good vendors, right? When it comes to, we need new countertops, we need new whatever. And so where we help clients most is we have introductions we can make on the insurance side. We don't buy insurance, we know people that do. And so as people are dropped from their policy for their 1980s building that has sprinklers and a lot of good things going for it, we know other clients that have picked up new insurance policies, maybe more expensive, but make them feel protected and also make it viable for a sale. So we make introductions there. I get a lot of calls about fighting tax assessments. I get a lot of calls about management introductions because the third-party manager's not doing as well. So we have a whole list of different vendors we work with that can help us answer those questions. But as far as solving it for the buyer on the sale, I think that's where the highest value in pricing comes in for the seller, because we can start to beat away at some of those concerns the buyers with the, like I said, the twos, too many, too little insurance, too many of this, too many of that. It's like, hey, we've solved this. We've got good lending options. We have a good insurer. We've got a good manager that's on a budget. We're ready to go. I think this is a great deal for you to buy.
Well, thank you all for attending. Really want to give thanks to our team. Thanks to all of you guys for showing up every year. Love to see you guys. If you have any questions, reach out to us, and let's ride this market to a new high. Thank you.